Good afternoon and welcome to this ACT video webinar, where today we are addressing liquidity, managing the critical challenges facing corporate treasurers in 2016. My name is Peter Matson, I'm the Engagement Director at the ACT. There's a menu bar across the bottom of your screen that allows you to open various windows, and you can move these around on your screen, resize them or minimize them. The green button with a question mark on it is for help if you have any technical difficulties. And another button opens the Q&A window. You can send in questions by typing in that window. Please don't wait until the end of the session. Just send in your questions as they occur to you, and we will attempt to answer them during the panel discussion. Our practice is that we don't disclose any names. I should add that a recording of this webinar will be available on the ACT website in 2 days' time, along with a separate copy of all the slides. To talk about this topic today, I'm joined by Nick Burge, Head of Liquidity at Lloyds Bank, and James Cherry, Market Dealer, Group Central Treasury at Shell. Our thanks to both of them for being here today, and to Lloyds for sponsoring this webinar. We're going to start today with a presentation by Nick Burge from Lloyds.
Thank you, Peter. So, looking at the challenges facing treasurers managing liquidity, and particularly looking at the challenges for 2016. So the key challenges we see managing liquidity. Liquidity, as we know, is the lifeblood of a company, whether it's making payments that are anticipated or much more difficult and challenging, working out how much liquidity you need to meet unexpected payments against unexpected events. In terms of challenges, the three main ones we see are a greater range of risks. The world is speeding up in terms of events, and sizing those risks and working out how much liquidity you need to hold against them. Corporates are holding larger amounts of liquidity in aggregate. And that's in a world where yields are at all-time lows, so managing and the cost of managing that liquidity is an ever-growing challenge. And thirdly, the complexity of managing liquidity, the changes driven by regulation, the range of products, etc. So, first let's be clear what we mean by liquidity and the definition. So, within this we're looking at liquidity from a corporate perspective. So on the left-hand side of the slide here, you have the sorts of liquidity, the secondary markets. So ability to buy and sell assets to manage your liquidity. Now, that's an area where we've seen significant changes over recent years. And that's an area where we're seeing a growing amount of challenge at a market level. And some of the old assumptions around secondary market liquidity, whether you can buy or sell assets at a time of your choosing, at a price of your choosing, and in the quantity of your choice, that assumption isn't always the case these days across many markets. On the right-hand side here, we have the primary markets. They've been functioning very well certainly from an investment-grade corporate perspective for many years. So available financing at what have been record levels, in fact, century low yields for many institutions. And that source has been, corporates have been able to raise significant amounts of capital, really with very limited challenges. We think that's starting to change, and one of the drivers there is a lot of that has depended on the QE and the activities of central banks. So again, the most recent announcements last week from Mr. Draghi in terms of, again, increasing the level of QE, the range of assets and the LTRO, that's continued to pump substantial amounts of liquidity into the market. But the ECB particularly, and central banks more generally, they've become not only the buyer of last resort, but in many cases they're now the buyer of first resort, and they're the main source of liquidity into the primary markets. So at the end of the day, corporates and businesses rely on the liquidity that they actually hold. What do you have on your balance sheet? What do you have in your reservoir? And that'll be either cash or investments or committed facilities available to you on your balance sheet. Now, as I said, one of the big challenges is the growing complexity of managing liquidity, and a lot of that's been driven by regulatory change. We've got a fairly complicated slide here in terms of the range of different regulations, and we're absolutely not intending to go through all of this. But in terms of, at a macro level, how it's creating challenge, we've bucketed the regulation into the four main pieces. And these regulations have obviously made the financial system and the banking system significantly safer. And they've achieved their main goal in terms of doing that. But there are unintended consequences and knock-on impacts for the users of financial markets and the banking system. So the bank capital and liquidity regulations, the Basel III or CRD4 regulations, fundamentally, that's resulted in increased capital requirements in the banking system against any particular risk. And that's been a very substantial increase in capital requirements. And what that's done is shrunk the overall capacity of the system, given you now need significantly more capital against any particular position. We estimated at a very rough level the European banking system overall aggregate balance sheets have shrunk from about 34 trillion euros equivalent pre-crisis to somewhere around 28 trillion, and they continue to contract. So that overall balance sheet capacity in order to meet the liquidity requirements of corporates has shrunk. And that's at a time when overall liquidity requirements and holdings of corporates have been increasing. The second theme and bucket of regulations has been bank structural reform. And at a macro level, that's making the landscape more complex for corporates. So certain products are now being moved into different entities. There's the impact of bank resolution and potential bail-in. So corporates now need to be more thoughtful and analyze the entities that they're dealing with. The third bucket is the market reforms, so whether it's EMIR or Dodd-Frank. What we have here is again increased complexity, significantly higher level of regulations across different markets, and also being implemented in different jurisdictions in slightly different detailed ways. So corporates, particularly global corporates operating across different markets, now have to take account for example, the reporting requirements in different jurisdictions. So again, making the treasurer's job more complex. And also those market reforms have resulted in some fragmentation of liquidity pools. So again, those different regulations and requirements mean liquidity in many ways that was very globalized pre-crisis, in many markets is becoming again more regionalized and some people would say balkanization of the system. So again, further complexity and increasing the workload for corporate treasurers. The way that banks look at corporates and look at business generally is also becoming more complex because of these different regulations. So historically, banks have operated through really one main return metric, which is the return on capital metric. The Basel III requirements around leverage, around liquidity, etc., now mean banks are operating across multiple different metrics. So again, we're not going to go through all the detail here, but the main takeaway from this is that banks are now looking at risk and pricing business, and therefore looking at their client returns in terms of multiple different lenses. So yes, absolutely, that return on capital remains key, but the leverage ratio means that absolute balance sheet consumption is another key metric that we have to look at. The liquidity coverage ratio, net stable funding ratio requirements mean we now look at client returns in terms of liquidity provision or liquidity take. So we need to size for liquidity, balance sheet, and return on capital. As an example, what we have here, to look at the sort of interplay and take one example, is how the risk capital ratio plays against the leverage ratio and some of the consequences from that. So on this chart, we have going from right to left, various different asset classes. On the right-hand side, the least risky, left-hand side, the most risky. And the solid green bars show us the capital requirement under the risk capital ratio. So unsurprisingly, the least risky assets, very little capital held against them, and the most risky, much more capital. The red bar shows the capital requirement under the leverage ratio. That's just a simple gearing metric. So in the case of UK, major UK banks, a 4.2% ratio. So we have to hold 4.2% of capital against any exposure. As you can see on that right-hand side, those low-risk products require substantially more capital under the leverage ratio than they do or did in the past under the risk capital ratio. So the consequence of that is, looking through the leverage lens, banks are having to either shrink their activities in those low-risk spaces or increase the returns to justify the capital held against those low-risk assets. That's resulted in, as I said earlier, shrinkage in bank balance sheets, but also shrinkage particularly in these asset classes. Let's pick repo as an example. What that means for corporates, particularly corporates using reverse repos for managing liquidity and placing their cash, is returns have improved substantially because repos have become more expensive, higher returning, and have become a more attractive asset class on a relative basis. And this has played out across the full range of products. And again, that means corporates now have to look at products and opportunities through these various different lenses. As I said at the beginning, we're looking at a landscape where corporates in aggregate are holding substantially more liquidity. The chart here shows aggregate cash and near cash on balance sheet of the S&P 1200. We've stripped out the financial institutions within the S&P 1200 universe. So this is basically a chart of cash and cash equivalent for the largest listed global companies. There'd be about 1,000 in this graph. As you can see, that cash and cash equivalent on balance sheet have increased by about 3 times since the beginning of the 2000s. So corporates are managing a substantially bigger amount of assets in an environment, as we said, where the overall capacity of the system is shrinking and returns on those assets are at record low levels and in many cases at negative levels if you're investing those assets in currencies with short-term base rates that are negative, or in low-risk assets, short-term low-risk assets with very low yield levels. So again, a larger amount of a bigger portfolio in a more challenging world. And then there's the sizing of the liquidity requirement. So this chart shows in a very stylistic representation how one looks at sizing one's liquidity buffer. So and this is showing liquidity need. So on the right-hand side is the largest amount of liquidity you might need, and we're scaling it against the probability of that need. So on the left-hand side is your normal day-to-day business, your anticipated payments, receipts. You'd have very high visibility of this. You're managing with a very high probability of outturn, and that's, I won't say it's easy because it's not, but is relatively easier to size. The challenge comes in this world where risk events are occurring more frequently and the financial consequences of those risk events are significantly bigger. So sizing that liquidity need against whether you're looking at the potential of a cyber attack, or you're looking at worst case revenue contraction, etc., these become difficult to model, and both probability and size. Now, we know from a recent survey we did of the boardrooms of our major corporate clients at Lloyd's that, and I guess unsurprisingly, in 2016, geopolitical risk is the top risk factor. Now, trying to anticipate outturns, and particularly to try and model the financial consequences to a business of that is a very difficult exercise. So corporates are looking across that lens. They're also, we know, in boardrooms again, looking more at these unexpected events, the financial consequences, whether you call them black swans, and the modelling around that, significant challenge. I was saying to my colleagues earlier that in many ways banks have it easier because we have a regulatory definition around liquidity buffers we need to hold. So modelling that liquidity requirement, and again we've got the same overlay in the background here, and one then is looking at what are the products, how do you hold that liquidity and how do you access additional liquidity. So we've split the chart in two. The top, what we call available liquidity, so this is cash, short-term investments, committed facilities, RCFs, letters of credit, etc. So this is your reservoir. This is liquidity that you know that you have available to you. And then below the line is additional liquidity that may be available, so either through working capital optimization, through raising additional liquidity in the market, whether it's through CP issuance or long-term bond issuance. You may have business levers that are flexible, so some of your cash requirements, whether it's for capex or for dividends, whether you have flexibility in that, there may be ways you can adjust your liquidity need and your liquidity buffer. And then at the far end, against very extreme events, again, depending the business you're in and the makeup of your balance sheet, you may have assets that you could dispose of in particular extreme events or equity issuance. So one needs to look at that whole quantum of available liquidity. So I think we certainly recognise, sitting in a bank working with our corporate clients, that this is just a very complicated and ever more challenging landscape to operate in, and those various different factors are intensifying. And then of course we're looking, as I said earlier, at a world where yields are very low, rates are negative in many of the major jurisdictions, so managing that liquidity buffer and the kind of risk against cost optimization of that is a significant piece of work for treasurers on a day-to-day basis. So that's an overview. I'm now going to hand over to my colleague James from Shell, who will run through from Shell's perspective how they look at this.
Thank you, Nick. So I'm here to talk about Shell's approach to liquidity, and I'm going to start doing that by really setting the liquidity scene at Shell. So typically at Shell we hold around $10 billion in our cash portfolio. At times it can be significantly more than this. For example, in the lead up to the BG acquisition recently, we were holding a good amount more. And really our cash position is very variable as well. So depending on what part of the capital business cycle we are in, and of course depending on the commodity prices. Not only is the cash very variable, it's also very volatile. So based on margin calls from our trading business, we can really see large intraday swings on our cash forecast. Because of that, we keep all of our cash relatively short term. And by short term, I mean between overnight and 3 months. Essentially, this also allows us to keep it as cash and cash equivalent under the accounting requirements on our balance sheet. Our investment policy follows that of what I expect most treasuries would follow. We prioritise security and liquidity over yield. We keep large amounts of cash in overnight, and this again refers back to how volatile our cash flow can be. For our overnight deposits, we tend to use money market funds. We appreciate the flexibility that they give, as well as the diversification of their underlying portfolios. Also, when looking at the yield of money market funds, we see it as a positive for them compared to sometimes 1 week or often 1 month investments. As Nick has alluded to, the regulations in the market are making it more and more difficult to place cash. We find this particularly to be true around quarter ends and year ends, for example. And because of this, we find it very important at Shell to have a variety of different options available to us. Typically, we have 4 main investment tools that we use. The first one is the bank deposits, and obviously as part of this, it's the structured stuff as well, for example, evergreens. We use reverse repo, money market funds, as I alluded to earlier, and we can also invest in corporate CP too. We are constantly looking to expand this list. We're very open to innovative ideas that people can put forward to us and stuff that we can come up with internally within the team. We're also constantly looking to expand our counterparties that we can use. And this really brings great diversification to our portfolio. As again with many corporate treasuries, I expect that credit limits will be based mainly around credit ratings, which is certainly something that we use amongst other things. In the current market conditions where lots of credit ratings are falling, it really does put stress against your credit limits. And as part of this is really why reverse repo has become a very good and helpful product for us. At Shell, we've been using reverse repo for around 8 years now. We operate it on a tri-party basis using Clearstream as our collateral manager. In terms of what collateral that we accept, it's very much only high quality government securities that we accept on the back of our deposits. One benefit that Shell does have that not all treasuries will is that we can hold portfolios in multiple different currencies. Based on the business cash flow, we're often seeing long positions in multiple currencies. As part of this, we can invest in these different currencies and look to swap our cash around as and when it's needed. This obviously provides more diversification, and also it gives us the operational benefit of having later cut-off times in certain jurisdictions. As Nick also alluded to on one of his charts there, you do have additional options available to you too, and Shell definitely does have these. We are able to issue commercial paper in both the European and the US markets, the US market being particularly helpful because it's often same-day cash that we can get hold of. But based on our conservative approach to investment, this is not something that we tend to have to do very often. My final point that I'd like to bring up is the other side of this. You can improve your liquidity management by improving your cash forecasting. And this is something that Shell is really investing a lot of time and effort into at the moment. We're looking to launch a new forecasting product very soon where we better use our data available to help us liquidity manage.
Thank you very much, James. That's very helpful to get the corporate perspective on that, and thank you very much to Nick for giving us an overview of where he thinks the banking sector is going. There's a range of questions that come to mind for me in both of your presentations, and there are some questions that I'm sure will come up through the question widget that you have on your screen. Let me start though, Nick, by picking out one of the slides you had there was showing the increase in corporate cash balances. But interestingly, that trend has been going on since, if not the late 1990s, then certainly the beginning of the 2000s. Now that's quite an interesting perspective, given you might have expected it post the financial crisis, but clearly that trend was there beforehand. Do you have any views on what that might tell us about corporate behaviour and corporate behaviour in relationships with their banks?
I think there's a number of different factors there, Peter, and you're right, this is a long-term trend, though we think it may have peaked. So part of it has been taking very aggregate observations, very favourable corporate earning conditions. So cash generation from corporates globally has been very positive. Recent profit warnings back end of last year, early this year, suggest we've probably peaked in the corporate earnings cycle. Second has been availability of cash in primary markets. So people have been, the attraction of raising funds at these very low rates has meant people have effectively built war chests. And then the third thing I think is people are much more focused on business risk, long-term risk, and just holding a bigger insurance cushion against what happens if this blows up or this catastrophe happens, and do I have the financial resources to meet that?
That leads me on to a sort of a secondary question there as well, is that one of the other graphs you showed was a sort of a grid mapping for corporates between their holdings of cash and their expected potential uncertainties of what's happening in the business. Have you seen that change as well alongside that balance of cash? Perhaps a different way of looking at it might be to say, does having more cash give people more of a blanket of security, or are they even more nervous so they keep more cash? Which is chicken and which is egg, do you think?
I think both are playing there. So people do want to hold more, or they want to hold more liquidity. So I think people hold bigger liquidity buffers than they would have in the past. And while one can optimize one's balance sheet for greater efficiency, the greater levels of uncertainty globally about what may happen, market conditions, and just the speed that events seem to happen now, people want a bigger cushion there. And then it's a matter of in what form do you hold it.
James, you talked about some of the specific business needs you have for the reasons for keeping large amounts of cash on balance sheet. Obviously, you talked about M&A, and there's the recent acquisition of BG, but you also talked about some of your operational cash requirements in terms of things like collateral. Could you give us just a little more flavour on how that plays in terms of the liquidity balances that you keep?
Yeah, definitely. So particularly in the markets at the moment, that the industry we're in, the oil price is extremely volatile. So on the back of that, our trading business are getting larger and larger intraday margin calls on that. So we are definitely keeping more cash sort of short term for that reason. In terms of the collateral that we get on the back of repos, that again can provide good liquidity for us, because we can reuse that collateral in other places in order to cover needs in that way.
You talked about also the credit issues in terms of looking at where you're placing cash, and you talked about money market funds and some other areas. You talked there about repos. You talked about using credit ratings as well as a marker. Do you have other markers of that nature that you use in terms of looking at counterparty risk as well?
Yes, we do. So one of the other key features that we use is, say, CDS rates in the market. So we'll be constantly monitoring those on our counterparty list, seeing how they're moving, seeing how they're reacting to market data. We're also, as most people will, we're just following market news too. So if we're seeing spikes in share price and things of that nature, then we'll be investigating as to why.
Okay. And over time, do you think that approach has changed? You talked very clearly about security, liquidity before yield, and you talked about keeping within the 3-month boundary, but do you think you might be at any time expecting to move over that and perhaps go a little further in duration to give you a little bit more yield, or are you comfortable with the parameters that you have?
Yeah, I think at the moment we're very much comfortable with the parameters that we have. We are, as you referred to again there, that we really do prioritise security and liquidity first, and the nature of the business really does make it difficult to forecast accurately, especially long term. And so if that means that we have to sacrifice some yield in the short term in order to meet those liquidity requirements, we're more than happy to do that for the time being.
Thank you. Nick, you talked there about cash as the asset, so the investing side of transactions. Perhaps I could ask you a follow-up question to the one I asked James there. Are you seeing corporates coming to you and saying, well, we have this dilemma between security, liquidity and yield? Is the duration question coming up for them? Is the counterparty risk question coming up for them? How are you seeing those sorts of interplays?
We're definitely seeing that, and particularly I think if you look at euros at the moment, it's having negative yields has really crystallised that as a question. Appreciating for James the business they're running, and the cash volatility is significant given oil prices and margin calls. For some businesses where cash volatility is a lot lower, they are now looking at, if they don't want to go down the risk spectrum in terms of credit, moving out in duration. So we have seen corporates, as I say, particularly in euro, extended duration significantly longer than they would have in the past because they haven't had to. And for corporates that really don't want to invest cash at negative yields, going out 6 months, 12 months, 1.5, 2 years even on deposits is becoming much more common. And if it's part of your kind of long-term stock, it makes sense.
And again, from the investing side, where's that money going? What instruments are they looking to? What markets are they looking to place out for that length of time?
We see it in the term bank deposit space, in repos, and sometimes in short-dated bonds. One of the issues, though, of the reduced secondary market liquidity is picking up short-dated bonds is actually pretty hard if you want to buy a reasonable quantum of them. They're either sitting on the balance sheets of central banks or they're locked up in portfolios. So a lot of it we're actually seeing in term deposits, and if it's corporate cash, banks are very interested in taking that.
You talked there a little bit about negative rates, so I'd like to go on to that as a topic, if I may, and I'll ask you a question on that in a moment, James. But just, Nick, from your perspective, are people seeing negative rates, do you think, as the price of doing business, or is it looked upon as negative return? In other words, is it an intrinsic part of their cash management activity, or is it a really irritant part of their cash management activity?
I think many of them certainly find it very irritating. Given the length of time, particularly euro rates have been negative, obviously and Swiss rates as well, but particularly in the euro space, and the recent cut again by the ECB further negative, we've seen during early 2016 a really big change. So we've gone from where really the vast majority of corporates would say we can't place at negative rates. We have issues with that, whether it's system issues or just general return issues. To people accepting, if they want short-term cash access and they want security, that means negative rates, and they're now, as you say, seeing it as a cost of having that liquidity and certainty.
And James, you talked about having a portfolio of currencies, if you like, or assets in currencies. Do you look at them individually? So you might say, I've got some money in euros, therefore it's negative in that short space, but I've got some money in Swedish krona, just for an example, so it's in a positive space. Actually, it probably isn't in Swedish krona either. So you're taking a portfolio approach, you're taking an individual approach, do you aggregate it, or do you do any inter-currency activity to try and give you more zip in your returns?
Yeah, that is definitely something that we look at. We look at our cash position as a whole, and if the rates allow us to switch between currencies, if we're long or short in a particular one and the return looks better, then yes, we are more than happy to swap our currencies into that level. Just to follow up on one of Nick's points, that the negative rates on the euros currently, it did sort of have initial issues. For example, systems, it was difficult to get that sort of around the current system limitations, but once that was in place, it was fine. And another element was accounting, so we needed to get the accountants comfortable with it. But once you've got past those a few initial hurdles, and there was obviously a couple of others, we really sort of still see a benefit in investing in euros even at negative levels.
Moving on a little bit, Nick, from the investing side, perhaps you talked in one or two of your slides about sources of funds as well, and some of the structural issues in terms of corporates accessing funds. You talked about investment grade, perhaps against sub-investment grade, and so on. Could you expand a little bit on where you see people looking now to find alternative sources, not of finance per se, but that more general liquidity issue?
I think we're certainly seeing people looking at liquidity at a kind of strategic level in terms of what's their overall business, the business risks they're running that are internal to the company or to their business sector, and then the global risks and the kind of overlay of how much liquidity that drives you to require. And then what's the makeup of your balance sheet. I mean, do you have things that in extremis you could liquidate and realise, not necessarily short-term investments, but you may have, I mean, depending on the type of business you're in, assets that are realisable. And that, if you do, that would reduce the total quantum of kind of cash investments you need. And then also whether you have flexibility in your business to reduce, if you hit a liquidity squeeze, whether you have things that levers you can pull to reduce the cash required at that particular time. And looking at that strategically and holistic is a much bigger focus.
And are you having clients coming to you and asking about the trade-off, if you like, between, well, we've got all this cash, but we'd like some more. Where do we get it from? What do we do with it when it comes in? Should we reduce the amount? And that sort of circular movement, again, it's a chicken and egg question. Where do you plant your flag on that one?
It really depends on the individual business, the individual client. So exactly how much RCF should you have? How much cash should you hold? What's the kind of best mix? What's the maturity?
And obviously, James, you're sitting in the Shell Treasury. You've got all this cash sitting in front of you, and your origination guys come in and say, we just did another bond issue for a couple of $1 billion. You don't mind looking after that for a week or two, do you? How does that interplay work out within your Treasury?
Well, it was something that we had on many occasions in the build-up to the BG acquisition, of course. But I mean, it makes it challenging, definitely for the sort of sums that we're talking about to find homes. But it's really, that's where having that choice available to you, so that you can invest this additional cash as and when it comes up. And that's why we're sort of continuously looking at new products that we can maybe invest in, or new counterparties, for example.
You're in the fortunate position to some extent that as a large organisation, larger than pretty much everyone else I can think of, that you've got the capability and the resource and the backup to be able to manage your way through a number of these systems. But even you mentioned you still had to get over some technology challenges, some accounting and audit challenges. Perhaps you could talk a little bit about one or two of those as well. And then maybe Nick, you maybe comment on that and what clients are asking you for advice on. Yeah,
I mean, I don't think size helps anyone get past sort of technical difficulties as and when they come up. I mean, it was things as basic as the treasury management system. How would it handle the negative rates and sort of the cash flows coming on the back of that? How would they go through the system? So it's really just making each of these things a joint project and getting involved with as much parts of the business as you can, whether it be tax, legal, technology, even like back office, for example, and just making sure everyone's aligned with what steps are coming and how we need to react to them.
I mean, Nick, and clearly, I say clearly, I'm assuming that even in the bank, you have the same sorts of issues when somebody says your return on that is -2. How does that work for you? But more broadly, when you have clients come to you asking you for that sort of advice, what sort of questions, what sort of issues do they have or presenting to you?
There'll be the full range. So exactly as James has said, it could be practical technology questions. It could be the products they're using and whether they should be using different products. It could be all around this modelling and trying to size liquidity buffers, the composition of them. And as you say, we're also a business too, and we have our own group corporate treasury that's facing very similar challenges and doing a very similar function to what James is doing at Shell. And in particular on the negative rates point, how does that affect the bank and its ability, not only with its own cash and not only with its own cash flow, but its ability to provide credit and to provide balance sheet to corporate clients? Because that clearly is going to raise some issues in terms of the cash return, but also the absolute return. Yeah, I mean, we as a financial institution obviously look at everything on a margin basis, on a spread basis. So it kind of moves down, but there is certainly a compression as yields get low and particularly as they get negative to that margin, and that's that's an industry-wide challenge at the moment. And it also begs the question, which I know is not really today's topic, around how effective continuing to lower interest rates beyond that negative bound. Takes me into a slightly different area as well. When you're looking at the range of products that are available to you, and you talked about money market funds in particular, do you have any, and perhaps this is for both of you, what concerns do you have about
about the issues of CNAV and VNAV in money market funds, and perhaps Nick, you might then comment on how you see that industry developing and where your clients are going with it. Perhaps James, you'd comment first.
Yeah, so I'll start by saying it's definitely something we're highly interested in. It's something that we're focusing a lot of time on at the moment to really get to a position of whether we will be happy to continue using them or not. And it's not a decision we've reached yet. So I won't sort of say what we're going to do on the camera here, but it's definitely something on our agenda, and it's something that not only will we have the sort of similar issues in terms of sort of technical stuff, for example, it's really something that we'd have to get past, let's say, the board level at Shell as to whether we're happy putting that sort of principle at risk.
That's a fair comment. And how is you, both as an advisor, Nick, but also sort of in a flow business, how are you addressing that particular concern?
It's something that comes up more and more from our clients in terms of, is it still going to be the same? I mean, it's not as it was, and therefore a lot of it will be very detailed accounting issues at a specific business or client level, which ultimately they'll need their accounting advice around. The capacity of that money market complex overall in aggregate has obviously, like many things, has shrunk over recent years. And that's a mix both of very low yields and also the regulatory impact. It's something that we continue to follow and help our clients on.
And do you see the rest of the industry in terms of cash as an asset management? Is it a growing industry for you? Is it a contracting one? Are we going back towards fewer but larger players, or are we going to have other entrants in the market? How does that play, do you think? Can you give us some hope, I think, is probably my question.
We see a growing trend for particularly large corporates like James, but generally across the industry, that corporate treasurers are becoming more like asset managers. So what once was a fairly simple activity in terms of some bank deposits and an RCF, people are now having to look at a much broader range of instruments and look at returns, risk, and across all the different dimensions.
It's a much bigger matrix than it used to be, clearly.
And for corporates, it's just a bigger part of the activity managing that liquidity.
Yeah. And James, where do you think you see that industry going? As I say, smaller number, but of larger players. Do you see other players coming in offering you bespoke or individual solutions? How do you see that? How do you see that working out?
Yes, I mean, I think we've seen it in the industry somewhat already that sort of there's been acquisitions in the money market fund industry, and there has bigger players have come out of that. In terms of do we see people offering us other products? Yes, we do. Quite often banks are coming to us, and I mean we're definitely happy to sort of hear these new options available to us, but we sort of don't want to lose track of we've got a team of dealers within Shell, and that's what we're there to do as well. So we're there to sort of find liquidity, and if one source becomes no longer available, which it may or may not, we don't know at this stage, then it's up to us to source it elsewhere and really sort of look into the market as to where we can find that.
Yeah, that's classic treasury activity in terms of searching out solutions and presenting the options to as you say, to your board. Just a last question, I think, as we come towards the end. Nick, for you, are you optimistic about the way in which cash management as a science and as an activity is progressing, or you just see it becoming much harder and much more complex and much more to deal with?
Being a natural optimist, Peter, yes, I am optimistic. While we laid out that it is becoming more complex, we're seeing in a positive light, as I say, it's a bigger part of what corporate treasurers are focused on, but they're managing through that very well.
And James, are you one word, optimistic or pessimistic?
Optimistic.
Excellent. Well, that's very good. Well, I think the time has come to wrap up. So my thanks to our presenters, James Cherry from Shell and Nick Burge from Lloyds, and to thank Lloyds for their sponsorship as well. Thank you too for everyone who joined today's session. I'm sorry if we didn't reach your question during our allotted time. You'll see from the slide there are details of future events and webinars that the ACT is running, and you can find those on the ACT website as well. If you can spare a moment to provide some feedback on this webinar, we'd be extremely grateful. Just select the feedback widget in red in the bottom bar. The facility to do this will remain open for a short time after the webinar ends. So from all of us here, thank you, good afternoon, and goodbye.